If you've saved into a 401k, 403b, 457, an IRA, SEP IRA, or simple IRA, in your 70s, you're going to have to take required minimum distribution. That is mandatory withdrawals that will all be considered taxable income. And there's nothing that you can do to avoid it. However, you can potentially minimize it. And in today's episode is our guide to required minimum distributions, the why, how much. And then, if you're not yet retired, we're going to talk about steps and strategies to help you reduce the impacts of required minimum distributions on your future.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome into the Retirement Show, all about your life, your money, and your taxes. My name's Scott Searens. I'm your host. My goal is to help you thrive in life, wealth, and retirement. And specifically in regards to retirement, today we're going to talk all about required minimum distributions. Now, I'm going to short form it a lot to say RMDs, but those required minimum distributions are going to be a huge part of your retirement. So today, if you're 55 and over, pondering retirement, if you've saved into a 401k, a 403b, a 457, an IRA, a SEP IRA, a simple IRA, all of what we're going to talk about today is going to apply to you. It's like a guide for those that are in pre-retirement, a guide for those that are in retirement, all about RMDs, because if you've saved into any one of those accounts in your 70s, you're going to need to start taking the RMDs, required minimum distributions. Required meaning mandatory. That's right. And so we're going to dive all into the world of RMDs. We're going to talk about the reasons behind why the withdrawals are mandatory from your retirement savings. We're going to understand the risk of not preparing in advance for these RMDs, and then talk about strategies to potentially avoid them. And then if you don't need your RMDs, sometimes I hear, hey, Scott, I just don't need these. I'm not going to spend them all. What do I do with my RMD? Can I just not take it? So we're going to talk about those questions as well, ways and strategies, things that you can do with your RMDs if you're not going to utilize it from an income standpoint. I think one thing that's going to help as I go in today is just some terminology, and we're just going to kind of try to keep things, rather than say a bunch of terms over and over again, we'll just kind of bring them into like one group and category. So, for instance, 401k, 403b, 457 accounts, IRAs, SEP IRAs, simple IRAs, those are all considered tax-deferred accounts. So when I say tax-deferred accounts, that's thinking about your 401k, 403b, 457, IRA, SEP IRA, simple IRA. Those are all tax-deferred accounts. Your tax-deferred accounts have required minimum distributions. Now, notice I didn't say Roth IRAs, and I'm going to talk about Roth IRAs at the end, where those fit in, whether or not they have required minimum distributions, but that's that tax-free bucket. Primarily up front here, what we're going to talk about is the tax-deferred bucket, all of those accounts that I just listed off to you earlier. So a lot of people aren't clear sometimes why RMDs exist. Why are they actually required to take, why are they required and mandated to take withdrawals from the retirement savings at a certain age? Sometimes I even hear, gosh, this isn't fair. They're going to tax me on my retirement savings. Well, actually, it is kind of fair, and let me explain why. For example, let's just say you've saved into your tax-deferred account. Let's just say when you were saving into your tax-deferred account, you actually received a tax deduction. So for example, let's say in the year 2022, you're making $150,000. That was your base salary, $150,000. You decided in the year 2022 to put $30,000 into your retirement savings, into one of those tax-deferred accounts. Well, the way that the IRS looks at this is if you didn't do anything, you would have been taxed on all $150,000 of income. But since you decided to put $30,000 into your tax-deferred account, they say, oh, okay, we're going to give you a tax deduction. So $150,000 But yep, we're not going to tax you on the whole $150,000 that you made. You put $30,000 into one of those tax-deferred accounts. So guess what? We're kind of shifting that $30,000 over here into this tax-deferred bucket. We're not going to tax you on it yet. In 2022, in our example here, we're only going to tax you on $120,000 of taxable income. So guess what? You haven't paid money on that money that you've put into the tax-deferred bucket. And so then, okay, we haven't paid money on it, but that was for our retirement savings, right? So most people think, hey, I'll just take it as I need it and pay the tax. Well, that would be great, but then there's also people out there who would just avoid taking it out because they never wanted to pay the income tax on it. And so the IRS has implemented these rules called required minimum distributions to help safeguard against people using a retirement account to avoid paying taxes. And guess what? The IRS, well, they want their tax dollars back. They said, hey, when you put that $30,000 away, we kind of made a deal together. Our deal was we're going to let you put it away and we're not going to tax you on it yet. You got a tax deduction that year that you put it away. Remember? Like we helped you lower your taxes, but guess what? We do want our tax dollars back. We're not just going to let you keep the money in the bucket forever. We need the tax dollars from that retirement savings that you put away. And that's all where required minimum distributions came in. So why do we have it? It's because we've never paid taxes on that money. The IRS wants their tax dollars back. When do we have to do it? So why? Let's move into when. Well, it's all based on your date of birth. And that's when the mandate starts coming. You can always take money, not always, after age 59 and a half, you can take money from any of your tax-deferred accounts whenever you want. Just remember, you're going to have to pay income tax on every dollar that comes out, right? Went away. You didn't pay tax on it, so guess what? You're going to pay income tax on every dollar that comes out. You can start taking, after age 59 and a half, start taking out money whenever you want without a penalty. You will have to pay income tax. It's just in your 70s is when they're going to start mandating that you actually take the money out. So let's just go through when do you have to start taking the required minimum distributions. And you don't want to miss this because there are penalties if you fail to take your required minimum distributions. And I'll talk about that in a second here. So first off, we talked about why. Let's go into when. If you were born 1950 or earlier, you should already be taking your RMDs. 1950 or earlier, already taking your RMDs. 1951 to 1959, you need to start taking your RMDs at age 73. 1960 or later, you have to start taking your RMDs at age 75. So now you know when you have to take it, but how is it all figured? What do you take out? So let's just say you turn age 73 next year in 2024. Well, how is it figured then? The IRS is going to have you add up or is going to take a look at a couple things. There's two things. It's the previous year end balance. Previous year end balance on your IRA accounts or 401k, 403b, etc. Previous year end balance. And then they have what they call as their life expectancy table. It's published by the IRS and it changes from year to year. So in 2024, you're turning age 73. You're going to look at your 2023 year-end value. You're going to look at the life expectancy table, do the calculation, and that's what's going to give you your RMD. Now, I'm not going to get into the intricacies here of how to do the calculation because you can go online and there's hundreds of RMD calculators out there. But I just want to give you the tools and the knowledge of basically what goes into this. Now, this is actually where we do start to separate some different items in that tax-deferred bucket. And I'll get to that in a second. But one thing first that I want you to realize is this life expectancy table, it's not a flat rate. And as you get older, the IRS, through their life expectancy table, is going to start mandating that you take more and more and more out of your tax-deferred accounts. So let me just give you an example on what I mean here. Let's just say you have $1.5 million in your account, and throughout your retirement, you were somehow invested that it stayed at $1.5 million throughout your retirement, even as you took withdrawals, right? Meaning you got some sort of growth in there, you're taking money out, some sort of growth, taking money out, and it just holds level, right, at $1.5 million. And I'm just using that because I want you to see the example here of how it's not a flat rate in what you need to take out from throughout your retirement for these RMDs. So $1.5 million, I'm going to tell you what your RMDs would be at age 75, 80, and 85. So here we go. If you had $1.5 million in your IRA account, age 75, you have to take out $60,975.61. At age 80, $74,257.43. At age 85, $93,750. So did you see there at each age that I gave, which was a higher age, it was also a higher RMD amount. It started in the 60,000s, it went up to 74,000 with some dollars there, and then it went up to over 93,000. So that's what I meant by the life expectancy table. It's not a flat rate. As you get older, the IRS is going to mandate that you take more out of these IRAs, 401ks, etc. And this is what can actually cause some tax issues in your retirement. And I'm going to talk about that in a little bit, but people underestimate this. And this is why all of a sudden you can have a higher taxable income in your retirement than where you might have been when you were working, because all of these RMDs are going to be taxable income. Okay, we'll talk about that in a second, but next I had mentioned that once it actually starts to taking your RMDs, now the IRS starts to kind of divide that tax-deferred bucket, and you've got different groupings within that bucket. For instance, IRAs, that's one grouping in that tax-deferred bucket. Your 401k, separate grouping. 403b, separate grouping. 457, separate grouping. Why am I talking about these as separate groupings? Well, because when you then have to take your RMD, they're going to look at these different accounts, and sometimes you can take money from, like, let's say you have 4 IRAs, you can just take money from one of the IRAs as long as it meets the total RMD value that you have to take. But if you have IRAs and 401ks, you have to take an RMD from your IRA, you have to take an RMD from your 401k. Here's what I mean. Let's just say you have 4 IRAs, okay? And through those 4 IRAs, just to use simple math for today's purpose here, let's just say your RMD is $100,000, right? So you're going to, all 4 IRAs, they look at the prior year-end value, put it through the life expectancy table calculation, and let's just say through all 4 of those IRAs, when you add up the individual RMD that you need to take from each IRA, let's say it comes out to $100,000. Well, here's the deal. You can take that $100,000 from one IRA. You could take $25,000 from each of the individual 4 IRAs. You could take $60,000 from one IRA, $40,000 from a different IRA. You could take 70 from one, 10 from another. Let's see, that's 80, and then 20 from a third and nothing from the fourth. Hopefully you're getting the point here. When it comes to the IRAs, you have to add up the total RMD that each individual one needs to have taken out, and then you can just take it from each individual one, or you can take it from one or multiple, however, as long as the total value of the RMD ends up coming out. Now, let's go to, let's say you have an IRA and a 401k. You cannot use that same process. So back to our example, your IRA, there is $30,000 of an RMD that needed to come out from that, and your 401k, there's $70,000 of an RMD that needs to come out from that. Well, guess what? You can't do $100,000 from the IRA and nothing from the 401k. That's not how the IRS looks at that. You have to do the $30,000 from the IRA and the $70,000 from the 401k. So IRAs kind of like group them together, right? But IRAs and 401ks, when it comes to the RMDs, You can't group them together. You have to take RMDs from your IRAs, RMDs from your 401ks. Okay, what if you have a spouse? Can you intermix RMDs in that relationship? No, you cannot. It's almost kind of like that IRA 401k relationship, right? Spouse number one has to take the RMDs that they're required to take from their accounts on their side. Spouse number two has to take their RMDs from their required accounts that are in their name on their side. They can't intermix, and just take them all from one account on one side or all from one account on the other side. Unfortunately, doesn't work that way. So each spouse needs to take their RMDs. Now, we've talked all about you got to take them, you got to take them, you got to take them. Well, is there anything out there that you can do to avoid them? No. You see, the risk if you don't take the RMDs is a penalty. That penalty is 25% of the amount that you fail to take. Let's go back to our example here. Let's just say you have $100,000 of RMDs that you need to take and you fail to take them. Guess what? The IRS is going to penalize you 25% or $25,000 in our example here, meaning they're going to take that and that money now goes to the IRS. It doesn't go to you. And on top of it, it's kind of like a double penalty because not only are they going to take that $25,000 from you, in our example, they're still going to tax you on the total $100,000 that you should have taken. So you're getting like a double penalty because you're getting taxed on it all, and then you have to give some to them. Now, let's just say, because life happens, things happen, you forget to take your RMD. Oh my gosh, 25%. Who wants to give that to the IRS? Well, as long as you correct it by the date the penalty is imposed, then they'll reduce the penalty down to 10%. But hopefully you see they're not really messing around on this. They do want their money back. And so either you're going to take it out or you're going to get penalized. And I wouldn't mess around trying to figure out ways to avoid it. But what you can do or try to find some different ways to help minimize it. You see, I find all the time people underestimate the impact that these RMDs are going to have on their future. And there's some risk that you face by, I'll say, not planning in advance for your RMDs. Meaning, as I talked about earlier, the value is just not a constant. And over time, the amount that you're going to have to take from your accounts could potentially go up. And as it goes up, it can put you into a higher taxable income bracket in your future than where you're at today. For example, working with different clients, I'll just give you one story here. A couple that I'm working with, when they were saving for retirement, they had saved, like everybody had told them to, into their 401ks. Multiple years of just saving into their 401ks. They'd saved up a few million into those 401ks, into those tax-deferred retirement accounts. That few million that they had saved into those tax-deferred retirement accounts, none of it has been taxed yet. So all of that money that they had saved is going to be taxable income in their retirement. And then, as I had mentioned earlier, with the life expectancy table and that value not being flat, you see, as we looked at a tax projection of their RMDs throughout their retirements, and then as they got into their 80s, into their 90s, next thing you know, because of these RMDs, the forced and mandatory distributions that they had to take out of these accounts, next thing you know, their taxable income was higher in retirement than where they were at today. So saving into their 401ks, they were actually costing them more tax dollars, potentially costing themselves more tax dollars in their future than where they were at today. So that's where we started to work through different strategies of how could they not, again, stop the RMDs from happening, but how could they help minimize them? How could they help reduce their taxes? Now, For them, they were still working. If you're still working and you do a tax projection and you see your RMDs are going to have an impact on your future like this, maybe one of the things that you want to do is switch from then contributing to your regular 401k or 403b over to the Roth 401k or the Roth 403b. If it's not offered, then maybe you just want to get the company match and then instead put your other contributions into your Roth IRA if you can contribute to that. The other thing that we started implementing in their situation, now everybody's situation is unique and different, but as we said, when we did the projection, we saw a higher taxable income in the future than where they're at today. We started to implement Roth conversions, paying tax today on that tax-deferred bucket money, getting it over to the Roth IRA, where then it grows tax-free and all of their future withdrawals will be tax-free as well. The other thing that we've done, not with this couple because they're still working, but another couple, is what we did is we waited until they retired. And once they retired, we said, okay, let's not take Social Security just yet. Let's not take a few other things just yet. And that's when they started to make withdrawals from their tax-deferred bucket when they were at a lower taxable income. And on top of that, we were starting to do Roth conversions. So we kind of waited for that employment income to go away. They dropped down to a different tax level, lower tax level, because they're no longer working. They basically had no income coming in. So now we're getting money out of that tax-deferred bucket at a lower taxable income, trying to get it out now before those RMDs might happen in the future. Another thing, and this might be a whole separate podcast, is I'm just going to talk about asset allocation really quick. One of the things that you want to consider is which bucket are you putting your equities in, which bucket are you putting your bond funds in, and things to look at is if you've got a taxable account and a tax-free account, those are the buckets that you might want to consider putting your equities in. This is what we do. This is how we kind of look at things for our clients. You put your equities in those buckets. Those will help from a tax standpoint. You put your bond funds in your tax-deferred bucket, right? So those don't grow as fast as equities grow. So if you have those in your tax-deferred bucket, they're not growing as fast, meaning you won't have a huge impact of RMDs in your future. But that's a whole nother subject on its own to talk about. But hopefully you can see here, there's just a lot when it comes to RMDs, when there comes to taxes. There's ways to potentially reduce your RMDs. There's ways to potentially reduce your taxable income in your future. If you're new to our show, if you're new to the thought of taxes and of RMDs, one thing that might help you out is our free guide to unlocking hidden tax savings opportunities. Now, you can get that at lifemoneyshow.com/taxes. Again, lifemoneyshow.com/taxes. If you're looking for ways to help reduce your taxable income and the taxes on your retirement savings, you might find that free guide helpful. Now, our last couple subjects here, I said we were going to talk about the Roth, and then we're going to talk about what if someone doesn't actually need the money from their RMDs for income. What do I suggest that they do with that money? And I do have clients that say, hey, Scott, you know what? We've got a pension coming in. We've got our Social Security coming in. We don't necessarily need the RMD this year. We don't need all of the RMD this year. What should we do with it? Well, first and foremost, I always tell them that they have to take it out, right? Because that is required. That is mandatory. Unless they're giving to charitable organizations. Then we might not have them take it out. You see, if you're giving to charitable organizations, a way to reduce your RMDs is through a qualified charitable distribution, QCD, where you give the RMD or a portion of the RMD. It doesn't have to be all of it. You can give a portion or all of your RMD directly to a charity. So going back to our $100,000 RMD example, your RMD that you have to take is $100,000. You take that out, that's $100,000 of taxable income. Mandated, right? Required, you have to. But let's just say you're giving $5,000 a year to a charitable organization. Well, instead, you give $5,000 directly from your IRA to the charitable organization. Now, your RMD is only $95,000. So now you only have $95,000 of taxable income. So it's helping to reduce the taxes that you'll pay on that money that you're going to take out. So if you were just giving from your checking account, now you might as well give directly from your IRA. Now you have to be age 70 and a half to be able to do that. What else? So you don't need the money. What can you do with it? Well, unless you're given the qualified charitable distribution, again, you're going to have to take the money out. Some things that you can look at is one is just reinvesting the money, right? You reinvest it. You have to take it out, but then you can reinvest it into a brokerage account, putting it in investments that are according to your risk tolerance in your future. So that's another thing that you can do is reinvest the money as well. And then last, what about these Roth accounts? Do we have to do anything from those? Well, guess what? This is why we like the Roth accounts here. We like contributing to Roth accounts here if it makes sense from a tax perspective for you to do so, because the Roth accounts do not have an RMD. No RMD. You may have heard that Roth 401ks have an RMD. They used to. That actually just changed with the new laws that Congress passed, where you don't even have to take an RMD from your Roth 401ks or Roth 403bs or Roth 457. So the Roth accounts, no RMDs. You can leave it in there. It grows tax-free. You take withdrawals whenever you want to. And then guess what? That also passes on to your beneficiaries tax-free as well. Now, when your beneficiaries get it, there are some required distributions. There's the 10-year rule, but that's we talked about that last week with inheritances. So go and listen to that podcast episode there about the 10-year rule. However, that is why the Roth account can become very, very powerful, as it is tax-free money that you do not have to take required distributions from, and then it passes along tax-free as well. So I have hoped that you've enjoyed kind of our guide here today in regards to required minimum distributions. If you've got one of those tax-deferred accounts, that 401k, 403b, 457, IRA, SEP IRA, simple IRA, don't forget, you're going to have to take those RMDs. If you're age 55 and over, now is the time to start planning. Don't wait until RMD age, because then it's going to be mandated and there's nothing at that point in time that you can do. However, if you start looking at it in advance, looking at it, heck, prior to age 55, but sometimes start focusing on it. You can do things in advance, right? Like switching over to your Roth 401k versus using your traditional 401k. Maybe you retire and you start doing Roth conversions to help minimize the impact of your RMDs. There's a lot of strategies that you can utilize to help lower the taxable income that you might have to pay in your future. And as I had mentioned earlier, we've got that free guide to unlocking hidden tax savings opportunities. You can get that at lifemoneyshow.com/taxes. Again, lifemoneyshow.com/taxes. Hope that you've enjoyed this episode. Subscribe on your favorite podcast player, and I look forward to our next conversation to helping you enjoy life today and being financially confident about your retirement.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.